Welcome to the deep dive, where we try to cut through all that financial jargon.
Get you those clear insights.
Exactly. So today we're tackling something pretty fundamental, really.
Yeah.
How do you quickly tell if a company's actually financially sound? Especially, when they're carrying a lot of debt.
Right. It's a common challenge. The financial world loves its metrics.
It really does. But some are like, almost like X-ray vision, yeah? They give you this immediate, powerful look inside. Okay, so let's unpack this specific one. We're diving deep into the debt service coverage ratio. You'll often hear it called DSCR.
DSCR, yeah.
Think of it as a vital shortcut. It's kind of a direct line to understanding if a company can consistently pay its bills.
And that's exactly what we're aiming for in this deep dive. We've sifted through a bunch of sources on this, and we're going to pull out the really important bits, clarify what DSCR actually is, how you calculate it accurately.
Right, the mechanics of it.
What those numbers truly mean when you see them, and why it's just so critical. For lenders, sure, but also investors, even the businesses themselves.
Yeah.
We want to cut through the complexity, give you those aha moments, show you the strategy behind this ratio.
Absolutely.
Yeah.
Because understanding DSCR, well, it isn't just for the finance pros on Wall Street.
Not at all.
It's really foundational knowledge. It helps you gauge financial health. Maybe you're looking at an investment.
Or applying for a loan yourself.
Or applying for a business loan, exactly.
Yeah.
Or maybe you're just curious about how this stuff actually works, how companies manage their money day to day. It's about empowering you, really, making sharper assessments.
So let's start right at the core. The debt service coverage ratio, DSCR. What is it? Well, essentially, it's a direct measure of a company's cash flow.
Okay.
The cash flow that's specifically available to pay its short-term debt obligations.
Short-term.
And here's the key bit. It includes both the principal part of the debt and the interest.
Ah, so not just the interest cost, the whole payment.
Exactly. It's a very practical look. Is the cash coming in actually enough to cover the cash going out for that debt?
Right. So it's less about theoretical profit on paper and more about the actual available cash hitting the bank account to meet those commitments.
Precisely.
Which explains why it's such a go-to for lenders and investors then.
Absolutely. They use DSCR constantly to evaluate if a firm has enough income coming in to comfortably cover its loan repayments.
It's about confidence, really.
Yeah, confidence that the business can meet its promises without, constantly scrambling for cash.
Makes sense.
And this ratio, it becomes especially vital for companies that are highly leveraged, businesses relying heavily on borrowed money.
Yeah.
For them, being able to consistently service that debt isn't just important, it's fundamental. A good DSCR isn't just a sign of health. It's almost a prerequisite for them to keep operating and growing.
So it's used across the board?
Oh yeah, widely used. Pretty much every industry. It's a standard indicator of financial health.
Got it. And just so we're crystal clear, when we talk about debt service, we're not just talking about any old debt figure, right?
Good point, yeah.
We're zooming in specifically on the cash needed to pay the required principal and interest.
The mandatory stuff.
Yeah, the mandatory stuff for a loan during a specific period. It's that recurring, non-negotiable cost of having borrowed money that DSCR puts under the microscope.
Okay, so we've nailed down what DSCR is and why it's so critical for spotting these financially sound companies.
Right.
But the real magic, or maybe the insight, is in the numbers. How do we actually get to this ratio? Let's pull back the curtain on the calculation itself.
Okay, the formula.
At its core, the formula is surprisingly simple. Almost elegant, really. It's just net operating income divided by total debt service.
NOI divided by TDS. Seems straightforward.
It is.
But, for our listeners who like to get into the weeds a bit, what's the really critical thing about net operating income, or NOI, when we're calculating this? Especially regarding what it leaves out.
That's an excellent question. Because while lots of people know NOI is basically revenue minus operating expenses,
Yeah.
the crucial part for DSCR is that it specifically excludes taxes and interest payments.
Okay. Before tax, before interest.
Exactly. If you're familiar with financial statements, you'll know NOI often lines up pretty closely with EBIT earnings before interest and taxes.
Right.
By isolating that income before you account for financing costs or the tax bill, you get this pure, unclouded look at the business's operational engine.
I see. It's about how much cash the core business itself generates, regardless of how it's financed or taxed.
You got it. That isolation gives you real clarity.
Okay, so if NOI is the top number, the numerator, what about the bottom number, Total debt service, or TDS. What exactly goes into that pot?
Right, TDS. This covers all the current debt obligations that are due within the next year.
All of them.
Pretty much the whole shebang. We're talking interest payments, principal repayments, any money going into sinking funds.
Sinking funds. Quick reminder on those.
Oh, sure. They're basically just special accounts companies set up to put money aside specifically for future debt payments, like a dedicated savings pot for debt.
Gotcha. Makes sense.
So sinking funds, lease payments even, plus any short-term debt, and the current slice of long-term debt that's due soon, the stuff you see on the balance sheet.
So it's the full, legally binding whack of debt payments for that period.
Exactly. The whole burden.
And there's a little wrinkle with the tax rate here, too, isn't there? You mentioned this isn't just some minor accounting detail. It actually affects cash flow. Why is that tweak important for getting an accurate picture?
It absolutely is, because this tax thing, it can subtly shift the picture of how much cash the company really has available to pay. Think about it.
Okay.
Paying back the principal on a loan, that's like giving $1 back to a friend. $1 out is $1 gone from your cash. Simple.
Right.
But the interest you pay on that loan, often the tax authorities give you a bit of a break on that. Interest payments are usually tax deductible.
Oh, okay. But the principal isn't.
Exactly. Principal repayments are made with after-tax money. So for a more precise TDS calculation, especially if you're planning or evaluating carefully, you'd actually use this formula. TDS, interest X, 1 tax rate, plus principal.
So you adjust the interest part for the tax saving.
Precisely. If you don't factor in that tax relief on the interest, you're actually making the debt burden look slightly heavier than it truly is in cash terms.
I see. You'd be missing a piece of the puzzle, maybe underestimating their ability to pay.
Exactly. It's about getting closer to the true cash impact.
Okay, so we've run the numbers, maybe used that adjusted formula, and we've got our DSCR number. But a number alone, well, it's just data, right? What story does it actually tell us? How do we translate that ratio into, strength or vulnerability?
That's where the benchmarks really come into play. They're critical for interpretation. So if a company has a DSCR of exactly 1.00...
Bang on one.
Yeah, bang on 1.00, it means they have just enough operating income to cover their debt service costs. They're paying the bills, but there's absolutely no breathing room.
Cutting it fine. Makes lenders nervous, I bet.
Very nervous. Now, if the DSCR drops below 1.00, let's say it's 0.95.
Uh-oh.
Yeah, that's a big red flag. It signals negative cash flow relative to debt. A 0.95 DSCR means they can only cover 95% of their debt payments from operations.
They're short.
They're short. They'll have to find that missing 5% somewhere else, maybe dipping into cash reserves, selling assets, getting more funding, none of which are sustainable long term. It shows they can't cover obligations from normal business.
Dangerous territory.
Very. And even if the DSCR is just too close to 1.00, maybe like 1.10.
Still positive, but barely.
Right. The company can look pretty vulnerable. Even a small dip in cash flow, maybe a slow sales month or an unexpected repair bill, could suddenly make them unable to service their debt. It's a precarious spot.
Okay, so what's considered good? What's the target?
Generally, lenders like to see a DSCR above 1.25. That's often considered strong. It indicates a comfortable cushion, a safety margin.
A buffer.
Exactly, a buffer. But here's where it gets interesting. A strong DSCR isn't just about playing defense, about safety. It's also about offense.
How so?
Well, that strong ratio often translates directly into better borrowing terms. Lower interest rates, maybe higher loan amounts, more flexibility from lenders. Investors see it and have more confidence, too. It actually creates this positive cycle for growth.
Ah, I see. So it's not just, can I pay my bills? It's, how much power does this give me?
Precisely. It can help accelerate your potential. And then a DSCR of at least 2.0 is usually seen as very strong. It means the company can cover its debt twice over. That's a substantial buffer.
Okay, accelerating potential. I like that framing. So let's connect this back to the listener. What does this all mean for you if you're maybe seeking financing or maybe you're on the other side assessing someone asking for money?
Well, lenders don't just glance at these numbers, they bake them right into the loan agreements.
Right, the covenants.
Exactly, financial covenants. They routinely check the DSCR and often require borrowers to maintain a minimum level, say 1.2 or 1.25 for the whole time the loan is active.
And these aren't just suggestions, are they?
Oh no, they're non-negotiable terms. Break the covenant and there can be serious consequences.
Let's make this real. Can you share some examples from the sources, show how this plays out?
Sure. Let's take a real estate developer. Imagine they go to a lender. Their projections show a net operating income of, say, $2,150,000 a year.
Okay.
And their total annual debt service principal and interest is $350,000.
Right.
You do the math. $2,150,000 divided by $350,000. That gives a DSCR of 6.14x.
Wow, 6.14. That's huge.
It's incredibly robust. What's cool here is how fast that simple calculation shows this really strong financial position. This borrower can cover their debt payments more than 6 times over from their operating income.
So for them, that likely means easier loan approval.
Absolutely. Faster approvals, probably better interest rates, maybe more flexible terms. They're in a strong negotiating position. It's like getting a financial gold star from the lender.
Makes sense. Any other examples?
Yeah, another one shows how lenders link DSCR directly to loan terms. There's a mention of MK Lending Corp.
Okay.
They explicitly offer more favorable loan-to-value ratios, LTV or CLTV, for investors who have DSCRs of 1.00 or higher.
So hitting that minimum 1.0 target gets you better terms.
Exactly. Why? Because the lender sees those investors as demonstrably less risky. The DSCR gives them that objective measure, and it directly impacts the deal you can get.
Right. It quantifies the risk. What about when things go wrong? Any examples of that?
Yes, and this one's a bit of a cautionary tale. Sun Country Bank. They had a loan agreement with the U.S. Department of the Treasury.
Okay.
And that agreement had specific financial covenants built in, promises about their financial performance. One key covenant was tied to their DSCR.
Let me guess, if it fell too low.
Exactly. If Sun Country's DSCR dropped below a certain level, let's assume it was 1.00. For this example, it triggered serious consequences.
Like what?
In their specific case, the agreement stated that the lenders would then get 50% of certain revenues the company earned for a period.
Wow, half their revenue. That's not just a penalty, that's a direct hit to their cash flow.
A massive hit. It's a direct redirection of the company's income straight to the lenders. And if you think about the bigger picture, it just powerfully shows how these covenants work. They're like built-in tripwires.
Safety nets for the lender.
Right. Safeguards that force a change, a reevaluation, maybe a grab of cash flow when that debt servicing ability starts to look shaky. The consequences of missing your DSCR minimums are very real. It can seriously impact a company's financial freedom.
Those examples definitely drive the point home. Now, some of our listeners might know other financial ratios. Let's maybe quickly compare DSCR to one people often hear about, the interest coverage ratio. DSCR is clearly powerful, but it's not a loan. How does it really stand out?
Yeah, that's a really important distinction to make, actually. The interest coverage ratio, you calculate that by taking operating profit, usually EBIT, and dividing it by the total interest payment.
Okay, EBIT divided by interest.
Right. And the key difference is right there in the name. Interest coverage ratio. It only looks at the interest payments.
So it doesn't factor in the principal part, the chunk you're paying back on the loan itself.
Exactly. It ignores the principal repayment entirely.
So it's only giving you a partial picture of the debt burden then. Like, can you afford the cost of the loan, but not necessarily the loan payment itself?
That's a great way to put it. And this is precisely where DSCR really shows its strength, why lenders often prefer it.
Right.
While the interest coverage ratio tells you if you can handle the immediate interest bills,
Yeah.
DSCR accounts for both the principal and the interest payments.
The whole enchilada.
The whole enchilada. That makes DSCR a much more complete, robust indicator of a company's true financial fitness, because it covers the full ongoing debt burden, not just the cost of borrowing.
It's like the difference between knowing you can pay the interest-only part of your mortgage versus knowing you can afford the entire monthly payment, principal, and interest combined.
Perfect analogy. That's exactly it. Okay. DSCR gives that more holistic view.
Okay, clear difference. DSCR is definitely comprehensive. But, you know, like any powerful tool, it's good to understand its edges, both the good stuff and the maybe limitations. Let's start with the advantages. What makes DSCR such a valuable asset in the toolkit?
Absolutely. So on the plus side, DSCR is fantastic for trend analysis.
Looking at it over time.
Exactly. If a company calculates its DSCR consistently, maybe monthly, maybe quarterly, they can spot trends. Is it going up, down, staying stable? They can project future ratios based on plans. And importantly, a declining DSCR can be an early warning signal. Hey, something's potentially going wrong with our financial health.
So it's good for planning and early warnings.
Definitely. Great for budgeting, strategic planning, maybe course correcting before things get bad.
What else?
It also offers really powerful comparability. Management can look at their competitors' DSCRs.
Benchmarking.
Right. How does our operational efficiency stack up? Are we using debt as effectively as our peers to drive growth? Or are they getting more bang for their borrowed buck?
Good point. Comparing leverage effectiveness.
And as we've hammered home, its comprehensiveness is a huge plus. It's just a more conservative, more thorough calculation than ratios that ignore principal. It includes the full payment.
Right.
And one last thing, it's often calculated as an annualized ratio, but on a moving 12-month basis, like the last 12 months.
So not just a single snapshot in time.
Exactly. That gives a truer picture of ongoing operations. It smooths out maybe seasonal bumps or dips and gives a better sense of the long-term trend rather than one potentially weird month or quarter.
Okay, those are some solid advantages. Trend analysis, comparability, comprehensive view, and that rolling average perspective. But no single metric is perfect, right? Where might DSCR fall short, or where do we need to be a bit critical when looking at it?
You're absolutely right. Every tool has its limits. One key thing is that the actual DSCR calculation can be adjusted depending on who's asking.
Lender requirements can vary.
Exactly. Some lenders might want you to use net operating income. Others might specify EBIT. Some might even use EBITDA earnings before interest, taxes, depreciation, and amortization.
Okay, so the income part can change.
It can. And depending on which one you use, particularly EBITDA, you could potentially make the income look higher by excluding things like depreciation and amortization.
Which aren't cash expenses, but they are real costs over time.
Right. They impact long-term cash flow needed for reinvestment. So this flexibility means the DSCR you're looking at might be calculated slightly differently depending on the context.
Raises a question, doesn't it? Is the DSCR showing the full picture of cash generation, or has it been, let's say, optimized for the calculation?
That's the critical question to ask. It highlights that potential gap between practical application and the theoretical number.
What else?
Well, another limitation is its reliance on accounting rules, specifically accrual accounting like JAP or IFR.
Okay, the accounting standard.
Yeah, debt payments, loan agreements, they're usually about fixed cash payments on specific dates.
Right, real money moving.
But the DSCR calculation, particularly the NOI part, is often based on accrual principles recognizing revenue when earned, expenses when incurred, not necessarily when cash changes hands.
So there can be a mismatch between the accounting picture and the actual cash flow timing.
There can be a slight disconnect. It might lead to minor inconsistencies when you compare the GAAP financial statements to the hard cash payment terms in a loan document.
Yeah.
Something to be aware of could lead to surprises if you're not careful.
Okay, and what about complexity?
It can be seen as a more complex formula than some other simple ratios, like, say, a quick ratio, might be a bit more intimidating for someone just starting out.
Fair enough.
And finally, there isn't really one single consistent requirement for DSCR across all lenders.
So no universal standard.
Not really. Lender A might want 1.25. Lender B might want 1.35. They might calculate it slightly differently, as we said. They have their own thresholds, their own methods.
So businesses seeking loans need to navigate that variability. What works for one lender might not work for another.
Exactly. It adds another layer of complexity to the financing process.
Okay, that gives us a good balanced view.
Oh.
So let's try and pull this all together now. What's the big takeaway from our deep dive into the debt service coverage ratio?
Well, fundamentally, DSCR is a really crucial financial ratio. It gives you this direct, pretty powerful line of sight into whether a company can actually cover its debt payments using the money it makes from its regular operations.
So thinking about our listener again, what does understanding this mean for you, someone who wants to be genuinely well-informed?
It means you have a tool with immense value, really, depending on your perspective. For lenders, it's obviously a core tool for managing risk.
Structuring loans, setting those covenants.
Exactly, protecting their investment. For investors, it's invaluable for making informed calls about a company's real financial strength. Does this company look solid, or is it perhaps overstretched? Gives you confidence, or maybe a warning sign, before you commit your capital.
Right.
And for businesses themselves, it's fundamental. Strategic planning, budgeting, making sure they stay healthy enough to get funding in the future. It's key for their own long-term survival and growth.
So understanding DSCR really empowers you to look past the surface noise and assess a company's ability to actually meet its financial promises.
Yeah.
Get you closer to the core truth.
That's it, exactly.
You know, understanding the DSCR, it feels like it's not just about crunching numbers, is it? It's more like seeing the financial heartbeat of a business.
That's a good way to put it.
And it kind of makes you wonder, doesn't it? What other, maybe seemingly niche financial metrics are out there, quietly shaping the destiny of companies all around us? Giving some the green light, maybe holding others back. And what could those metrics tell us if we just knew how to look, how to interpret them?
Always more to uncover.
Definitely. We hope this deep dive has given you some valuable insights. We encourage you to keep digging, keep asking those sharp questions, and keep exploring this fascinating world of finance.